Right now, in city after city, homes are stagnating, mortgage stress is rising, and cracks are appearing in America's once rock-solid real estate foundation. What if I told you we may be on the verge of a collapse, and that you, as an investor, renter, or homeowner, could lose more than you think? In the next 8 minutes, I'm going to pull back the curtain. You're going to see exactly why America's real estate is faltering, and more importantly, what you must do to protect your wealth before it's too late. For decades, U.S. real estate has been relied on as a bedrock asset class, wealth creator, retirement safety, legacy building tool. But in 2025 and beyond, there are mounting warning signs, from oversupply in some markets, to mortgage stress, to looming foreclosures. Behind the scenes, geopolitical risk, inflation, interest rates, and financial leverage are pushing things toward a tipping point. You pause, maybe insert a quick pattern interrupt, humorous rhetorical question. What does this mean if your neighbor down the street is trying to unload their house for 20% off? Yes, that's happening. Then you tease your main points. We're going to explore 3 major fault lines in American real estate, and by the end, I'll show you exactly how to position yourself so you come out ahead, not wiped out. For years, the housing market was like a one-way escalator, prices only seemed to go up. Sellers called the shots. Homes would vanish in days, sometimes hours, with bidding wars so crazy it felt like an auction house. But now, the tide is turning. Inventory is quietly rising. Homes are sitting longer. Price cuts are spreading like cracks in the pavement. According to Zillow, U.S. home prices could fall about 1.7% between March 2025 and March 2026. Doesn't sound like much, until you realize dozens of metro markets are flashing red, marked high risk for deeper declines. If demand disappears overnight in your area, your home's value might drop 10, maybe 20%. That's not just a number. That's your down payment, your equity, your safety net, evaporating. Yes, even your cousin, the one who swore real estate is always safe, might be in for a rude awakening. And that's just fault line 1. But fault line 2? That one hits even harder. Let's talk about the silent killer of affordability, interest rates. For most of 2024, the average 30-year mortgage hovered above 6%, and experts say 2025 won't bring much relief. Every tick higher in rates locks out thousands of potential buyers. This creates what economists call the rate lock problem. Millions of homeowners are sitting on golden mortgages, locked at 2.5% or 3%. Why would they sell and trade up to 6.5%? So the market freezes. Sellers don't sell. Buyers can't buy. And prices hover in a no man's land. Imagine this, you're ready to buy, but your neighbor won't move because their mortgage is half the cost of yours. You're trapped, not by walls, but by math. And as months pass, pressure builds. Rising defaults. Stretched payments. Banks quietly watching their balance sheets tighten. When that pressure hits a tipping point, that's when panic begins. It's like trying to get into a nightclub, but the bouncer just doubled the cover charge. Suddenly, everyone's standing outside, frustrated. Supply is climbing. Rates are biting. But the third fault line? That one might break the entire foundation. While everyone's watching home prices, another storm is brewing in commercial real estate, offices, malls, apartment complexes. These buildings were bought and financed when money was cheap. Now, occupancy is down, rents are falling, and refinancing costs have exploded. Many owners borrowed heavily during the boom. Now, with weak cash flows and higher capital costs, defaults are accelerating, and the domino effect could be brutal. Banks and REITs that finance these projects are carrying billions in loans that may never be repaid. If those dominoes fall, the shock could spread from commercial markets straight into residential credit. This is how contagion begins: one sector breaks, and the rest follow. A mall default in California. An office tower foreclosure in New York. Suddenly, confidence evaporates everywhere. And here's the truth: when confidence cracks, markets don't just decline, they cascade. So with all three fault lines active, supply, affordability, and debt, what happens next? Because the next act is personal. If these fault lines converge, the impact could be sweeping: falling home prices, rising foreclosures, tighter credit, and markets that take years to heal. Homeowners carrying too much debt will feel the pressure first. Investors who bought at peak valuations may be forced to sell at a loss. Renters might face wild swings, rent spikes in some areas, vacant properties in others. But, and here's the truth most miss, this is also when real wealth is built. When fear blinds the crowd, clarity becomes an advantage. Those who move smartly, not emotionally, turn downturns into defining opportunities. So, what should you do now? 1. Stress test your exposure. Start by looking in the mirror. If home values drop 20 to 30%, could you handle it? If your mortgage adjusts next year, can you afford the new payment? Run the numbers before the storm hits. 2. Refinance or hedge if you can. If you're sitting on adjustable rate debt, fix it. If you can't refinance, look for ways to hedge exposure, reduce other risks. This is about survival first, profits second. 3. Diversify. Don't let all your wealth ride on one roof. Your home shouldn't be your entire portfolio. Spread risk. Add exposure to other assets, high-quality stocks, real estate investment trusts in stable sectors, or even precious metals. Diversification doesn't mean panic, it means preparation. 4. Deploy capital with patience and precision. In distressed markets, opportunity hides in plain sight. Commercial properties, office space, and secondary metros are already flashing discounts. But move only if you have margin of safety and deep due diligence. Remember, cheap isn't always value. 5. Hold dry powder. Liquidity is your edge. Keep cash or accessible capital ready. When the headlines turn darkest, that's when the best deals emerge. Track the signs: foreclosure notices, delinquency data, vacancy rates, interest rate trends. I know this sounds risky, but history is clear. The greatest fortunes were built during chaos, not after it. If you wait until the crash is obvious, you're already too late, because that's when the bargain hunters show up, not you. We uncovered 3 powerful fault lines: rising inventory and weakening demand, mortgage stress and rate pressure, and commercial overleverage. They're converging now, reshaping America's real estate landscape. But every collapse creates a reset, and resets create opportunity. If you act wisely, decisively, and with clear risk controls, you won't just survive this cycle. You'll own the next one. If you're serious about protecting and growing your wealth in unpredictable markets, here's your next step. Hit like if this opened your eyes. Click subscribe and ring the bell, because we're just getting started. And I've put together something for you, a free downloadable checklist and opportunity scanner, the link's right below. But most important, take one step today. Review your real estate exposure. Stress test your numbers. Don't wait. Thanks for watching. Be bold. Be prepared. And I'll see you in the next one.